together so they could become part of this group, get their hands on that. Get a job in this sector, that's what I'm working my way there, but have shares or do something that share owning folks will likely buy. They didn't think of it that way. They were going to what the dynamic sector of American economy, but that's what it was. The dynamic sector is this. Okay? So, yes?
So, this is kind of like the argument of trickle down. What would the trickle down people say is the ones who argue?
Yeah, the trickle down would argue that this group of very wealthy people at the top will disperse some of their wealth down. So they will buy a second and third car, and that'll be real good for the neighborhood mechanic. The problem with that argument is, remember, they're doing better, but these folks are not doing better. And you have to weigh the impact on everybody of this reality against that reality. And they concentrate the wealth, and in the end, it hasn't been a great boon for the mass of the American people. But it has been a very good time for the top 10%. They've done very well. They've gotten their hands one way or another on this. Okay? Next group that gets their hands on this. Think of it this way. What does a corporation do with the money it puts into the bank, these profits? If, as I told you, it is not about expanding production here because of the stagnant market, then basically they give these managers in the banks an instruction. Make money with my money. I mean, that's after all what I'm doing. I'm out here working in whatever the corporation is that's earning more profits. I've made the profits. I've deposited in your bank. Make money with my money. That's your business. My business is making shoes or widgets or whatever it is. You're in the finance business. Go out and make money with my money. And because if you don't, I'm going to go give it to somebody else, another bank, another financial hustler. So suddenly, not only is the financial sector of our economy, banks to start with, awash in discretionary money. Remember, not the money of a worker who's going to take it out to pay bills and give presents, but the corporations and the wealthy executives who are beginning to get a lot of money. And not only are the banks getting all this profit, this discretionary money put at them, which is not there to lubricate the economy, but to make money for the depositor, to make money for the company or the executive who puts their money in. But a new demand is made on them. Find profitable outlets. Otherwise, we're not going to give you the money. We're going to start bypassing you. We don't need you. We're going to go out and we're going to find or set up, if we can't find them, altogether new financial institutions, financial enterprises that will make money for us, because if you stodgy old banks can't, if you're not up to it, screw you. Now, I'll give you an idea. Something called an investment bank took off in the 1970s. This is not a bank the way you're used to, which is called a commercial bank. You put a deposit in, you borrow some money occasionally, you use it to have your checking account, you put a little savings in there. That's a commercial bank. An investment bank is a bank that takes money to make money with it. And they took off. They really took off. They were there before, but they took off. Because that's what this money was looking for. Make money with the money. Big names, Lehman Brothers, Goldman Sachs, those kinds of places. When corporations weren't satisfied, even with Lehman Brothers and Goldman Sachs and Merrill Lynch and some of the others, big ones that did this, they began to look for new financial players. People to whom they could give their money, corporate money, individual executive money, big money, millions at a time, who were nothing but specialized financial hustlers, who knew what the bankers knew, but knew how to get a special deal, how to lend money over here, how to make a special contract over there. These new little groups were set up because they said, we don't want to be a bank, because if you're a bank, you're subject to all the rules. A lot of regulations govern what banks do. We don't want to do that. We want to be very nimble. We want to find a clever way to make money with your money. What's the name, the generic name that we came to give these new institutions? Hedge funds. That's all they are. They're specialized new financial institutions whose job it is to cut deals, to work around, to get better terms for a deal than the old stodgy banks did. And they threatened the banks. And then banks went and tried to make deals with them. They tried to work this out so they could divide this tremendous pie. But in the process, this industry grew. In the last 30 years, finance grew faster than any other industry in America, dwarfed everything else. Millions of people got jobs in these expanding investment banks, in the commercial banks that grew as well, in the hedge funds. The best and brightest young people coming out of colleges and business schools went to work in finance because that's where the action was, that's where the salaries were spectacular, and that's where all the romance of everything was. It was the expansion, it was the growth, it was the leading sector, all these different terms were applied, and you can see the whole culture funneling these energetic people who had to work often in this city. You're living right in it here, in New York City, down in the Wall Street area, who told the usual stories. I have to work 60, 70 hours a week. I have to be available on Saturday and Sunday to work, and that. But then after 10 years, they could relax into a senior job, earn a ton of money, and do no more work. Sort of the equivalent of academic tenure. And go to sleep if you don't care about the job. You could just coast. And you had a lot of that there too, as you do in all industries. But for a time, in the 80s and 90s, this was the dynamic sector. Okay. Last step. The most popular place to try to make money with money turned out in the 80s and 90s to be the stock market. The stock market. And there are good reasons for that. It is traditionally the place where people play who have money. In the 1970s, as today, the vast majority of stocks are owned by a relatively small amount of very wealthy players. And what became very popular in this investment community, in this finance community, was to take these profits and basically begin to play the stock market in a variety of ways. It made some critics begin to label American capitalism in the 80s and 90s with a nasty name. It was called casino capitalism. Because people were focused on the stock market in those years. Why? Well, first, lots of new companies were developing to serve this market. Producers of every conceivable kind of computer. Because remember, this is partly what makes the productivity go up here is the computer. Companies have lots of money. They want to save on their labor costs. And so they're in the market to buy. It was the year when everybody buys a new computer every 3 years. Even though it's perfectly good, the old one, you throw it out because the new one has more megahertz or whatever, and you want that. You can't justify it for much of anything else, but it becomes a hit kind of thing. You want every new device. You want every new sign of your corporate success, that you have the latest whatever it is. And many companies begin designing. It's very important. You explode with these little companies that start up out of nowhere, but they can do that. And the United States becomes very technologically dynamic, much more than it was in the years before. Producing, by means of this thing, which becomes famous, an IPO, that's called an initial public offering. It's when a little company that gets going for a few years decides it can now appeal to whom? To the world of the investor. You know, we've been doing some business. We have a product to show. Look, it's good. Here's some people who've bought our product. They're real happy with it. So give us a bunch of money, buy our new shares, so we can expand and really make money with this new technology, this new gizmo, whatever it is. And people who have a lot of profits, seeing glittering opportunities, started moving money in there. big time. Technology was the leading sector, but it wasn't just that. Companies took off that, for example, figured out how to make fancy houses in a new way. Boom, they would take off because they had this market. So all of that. And so the stock market really took off. From 1982 to 2000, those 18 years, the American stock market never had a run like that. Spectacular. The Dow Jones index, if you follow it, or the NASDAQ index went into record territory. Territory they don't have anymore now. They've lost all that. But in those 18 years, we had a spectacular explosion as this money moved into stocks and bid up the stock prices. I'll give you an example. In 2000, March, the NASDAQ, which became when this period started, the old dominant stock market in America was called the New York Stock Exchange, where the Dow Industrials are located. By the end of this period, this is the more important stock market. This used to be the stock market of little companies, startup companies, technology companies. But it became dominant across this year. It's now more important than the New York Stock Exchange. Anyway, the index, which is just an index of how high the prices were, stood around 5,000 in March of the year 2000. Today, it's 1,600. In other words, from the beginning of this decade we're in to now, this is the equivalent of 1929. It's a collapse. The stocks shot up and then, boom, fell apart. Why? Because the flow of money into the stocks was so much of a bubble, it got to be called, a kind of hysteric rush of wealthy people to make even more money by buying shares, and they began to compete with one another. A company that had never made any money, but looked like maybe it would come up with the next best thing in whatever it was, would get huge amounts of people buying its IPOs, paying wild amounts of money. Hustlers got to going who would buy an IPO. I did this myself a couple times for people whose money I managed. A new company comes up. You had to be crazy not to see this. There was a euphoria. So when the company first announced its IPO, everybody would get shares. Not because you believed in the company, but you believed in the hysteria. So you'd buy the shares at, say, $100 on Monday when it opened. By Friday, they'd be $200, as everybody who couldn't get one when they opened up wanted to come in later. So you bought on Monday at